The current student loan crisis, a towering $1.75 trillion black hole of non-dischargeable debt, is not an accident. It is the calculated, predictable result of a 60-year policy sequence that weaponized access to capital, transforming higher education from a subsidized public good into a predatory, profit-driven enterprise. To understand the collapse, you must first understand the foundation it was built upon: the deliberate, step-by-step introduction of unlimited, unsecured credit. The story begins in a moment of national panic, not academic idealism. In 1958, the Soviet Union launched Sputnik, an event that shook the American establishment to its core. The response was the National Defense Education Act, NDEA. Ostensibly, the NDEA was a tool to produce more American scientists and engineers to win the space race. In reality, it was the first critical domino to fall. By making federal loans directly available to students, the NDEA bypassed the state legislatures and private endowments that had previously constrained tuition growth. For the first time, a national mechanism existed to funnel vast, federally backed capital directly into the university system, regardless of the quality of the product or the student's ability to repay. The concept of higher education began its slow transition from a supply-side constraint, limited by state funding and endowments, to a demand-side vacuum, limited only by the student's willingness to sign a loan document. The NDEA introduced the first crack, but the system's structural integrity was truly destroyed by the Higher Education Act, HEA, of 1965. This law, and its subsequent reauthorizations, solidified the federal government's role as the universal guarantor of student loans. The most fatal innovation was the Guaranteed Student Loan Program, GSLP, which later evolved into the Federal Family Education Loan, FFEL, program. Under FFEL, private banks issued the loans, but the federal government guaranteed them against default. Think of this like a mortgage crisis, but with zero risk for the lender and non-dischargeable debt for the borrower. In a normal market, when a bank loans money, it assesses risk. If the borrower defaults, the bank loses money. This risk forces the bank to be judicious about who it lends to and for what purpose. It constrains the price of the asset being purchased. But the GSLP FFEL model eliminated this constraint entirely for the universities and the loan originators. The university knew that any student they admitted, regardless of academic qualifications or career prospects, could secure the entire tuition cost with a federal loan. The money was guaranteed to arrive up front. This created the perfect moral hazard. Why bother to control costs or improve academic quality when the revenue stream is guaranteed by the U.S. Treasury? The lender, bank, knew that even if the student defaulted, they wouldn't lose a penny. The federal government would simply cover the loss. This incentivized banks to push as many loans as possible, regardless of the borrower's risk profile. The incentive was to maximize volume, not assess creditworthiness. This structural perversion, the elimination of risk on both the supply side and the lending side, is the core engine of the tuition bubble. It created an environment where the demand curve for education became perfectly inelastic. As long as a student could sign a loan application, the university could raise the price with impunity, knowing the demand for their credential would remain high. For over 3 decades, the system slowly inflated. The price of tuition began to rise at a rate that consistently outpaced inflation, healthcare, and housing. From the 1980s onward, as state funding for public universities began to be systematically reduced, a process accelerated by political priorities and the existence of the federal loan backstop, institutions simply covered the gap by hiking tuition, funded directly by the limitless pool of guaranteed federal debt. The schools transitioned from receiving state subsidies to receiving student-borrowed debt subsidies. The final catastrophic break came in 1978 with the Middle Income Student Assistance Act, MEAS-A. This seemingly benign piece of legislation eliminated the income and need-based requirements for federal loans. Before MISA, federal support was predominantly for low-income families. After MISA, anyone could qualify for a federal student loan, regardless of wealth. This wasn't about equity, it was about injecting a massive, untapped pool of middle-class liquidity into the tuition market. It completed the final step in the grand experiment, ensuring that every segment of the American population, from the poorest to the upper middle class, was now tied to the university's financial model through the iron chain of debt. This chain was forged and made unbreakable in 2005 with the Bankruptcy, Abuse Prevention, and Consumer Protection Act, BAPCPA. This law made it nearly impossible to discharge student loan debt, even private student loan debt, in bankruptcy, requiring a nearly impossible standard of undue hardship. Think about that for a moment. Most other forms of unsecured debt, credit cards, medical bills, personal loans, can be discharged. But student debt is treated by law as an unbreakable covenant, a financial shackle far more binding than a mortgage. The very people who are statistically least able to handle the burden, young adults with low or no income, are granted access to massive, life-altering debt that they cannot escape. even through financial catastrophe. By 2005, the model was complete. Unlimited credit. Federal guarantees ensure a bottomless pool of money. No risk for sellers. Universities and lenders get paid regardless of student success or default. Maximum liability for buyers. Debt is non-dischargeable, a 30-year anchor tied to a graduate's earnings. This structure is what created the tuition bubble, driving the cost of a degree up over 1,300% since 1978. It transformed the university's incentive structure from one focused on teaching and research to one focused on enrollment maximization and debt capture. This shift is the prerequisite for the second stage of the collapse, administrative bloat. The immediate, predictable consequence of the student loan debt machine was the explosion of non-academic spending, a phenomenon now universally recognized as administrative bloat. With a guaranteed stream of federal revenue, universities faced a new financial reality. They did not need to be efficient or academically rigorous. They only needed to expand enrollment and find new ways to spend the guaranteed tuition dollars. The academic mission of teaching and research became secondary to the financial imperative of institutional growth. The evidence is staggering and forms the cancer at the heart of the university model. Since 1980, the number of full-time non-instructional administrators and staff has increased by over 150% across the American university system. During the same period, the number of tenured faculty has barely moved, and the ratio of faculty to students has generally declined, often replaced by low-wage, non-benefited adjuncts. At many major universities, there are now more non-teaching administrators than there are teaching faculty. Where is this money going? It is not going to the core educational product. Tuition revenue is being funneled into two primary areas. The luxury arms race. Universities, particularly large state schools and mid-tier private institutions, began competing for students not on academic reputation, but on amenities and experience. This led to a construction boom of unimaginable extravagance. Rock climbing walls, resort-style student housing, lazy rivers, elaborate dining halls, and state-of-the-art recreation centers. These are expenses that provide little to no instructional value, but are highly effective marketing tools to attract 18-year-olds who are paying with debt they do not yet comprehend. This is the financial equivalent of a terminal patient spending their last dollars on a gold-plated hospital bed. The debt-laden student pays for the luxury, which is used to attract the next debt-laden student, the bureaucratic hydra. The most pernicious form of bloat is the explosion of the administrative class itself. This includes VPs of student life, assistant deans of engagement, diversity and inclusion officers, compliance directors, marketing and communications teams, and an army of mid-level managers. These positions exist to manage the system of debt, compliance, and student services that the university's growth required. They are a self-licking ice cream cone. Compliance, managing the ever-increasing complexity of federal student aid programs, Title IIs, Pell Grants, HEA, requires a massive staff of financial aid and regulatory compliance officers. Recruitment.choice marketing. As institutions grow, they need vast marketing departments to justify the high tuition and attract a national or global student base to fill the new dorms and facilities. Student services. The need to cater to the student as customer, which is required to justify the tuition price, creates new demands for counseling, mental health services, and specialized administrative support. Again, services that do not contribute to the core academic output. The result is a grotesque financial distortion. A Bold and Math at BF, 2014 $1 study by the New England Center for Investigative Reporting found that from 2003 to 2012, spending on instruction at public universities increased by only $10 billion, while spending on administrative overhead increased by nearly $27 billion. The ratio of administrative staff to students grew by $20 at some institutions. Furthermore, this class of administrators, unlike the faculty, commands high inflation-adjusted salaries and benefits, contributing directly to the tuition spiral. The financial incentives of the institution shifted from valuing the teaching professor, who generates knowledge, to valuing the enrollment manager, who generates revenue. This bloat fundamentally changes the risk-reward calculation for the university. Because administrative salaries are fixed, they represent a high, non-negotiable floor on operating costs. In a business that faced market constraints, this bloat would be purged during an economic downturn. But in the university model, when a financial crisis looms, the administration does not cut its own high salaries. It simply raises tuition for the incoming class, relying on the federal debt backstop to cover the difference. This transfer of risk from the institution's balance sheet to the student's personal future is the mechanism that ensures the tuition bubble can only inflate. The administrative class is now the single greatest lobby for the continuation and expansion of federal student loan programs. The entire financial security of this burgeoning bureaucratic sector is directly tied to the student's ability to borrow $100% of the sticker price. They are the parasites that have infected the host body, and their growth has now metastasized to the point where they are consuming the host's vital resources. The academic quality itself has been the chief casualty. Resources diverted to the luxury arms race and administrative oversight are resources pulled from libraries, research labs, and, most critically, instructional faculty. The rise of the low-paid, overworked adjunct is the final symptom of this disease, representing the university's final desperate attempt to maintain the facade of teaching while funneling the maximum amount of debt revenue into the administrative core. This hollowed-out academic core is what makes the coming collapse not just a financial correction, but a crisis of institutional purpose. The next stage of this analysis must address the product of this perverse system, the tuition bubble itself, and how it has reached the point of maximum systemic fragility. The convergence of unlimited student debt and malignant administrative bloat has produced the tuition bubble, a towering monument of risk that eclipses the subprime mortgage crisis in both scale and systemic threat to an entire generation of Americans. This bubble is defined by a widening disconnect between the price of the asset, a college degree, and its underlying economic value. In the mid-20th century, the wage premium associated with a college degree made the investment nearly foolproof. Limited supply and high public subsidy ensured that higher education was an economically rational choice. Today, however, the degree has become an economically coerced necessity, a debt-financed barrier to entry for the middle class, whose value has been deliberately diluted by the very institutions that sell it. Let us quantify the structural fragility of this bubble. 1. The price-to-value disparity. The cost of a degree has risen more than 1,300% since 1978. Meanwhile, median real wages for college graduates, though still higher than those of high school graduates, have remained largely stagnant for decades. The job market is now saturated with degree holders forced into positions that do not require a college education. This is graduate underemployment. A generation of young adults is being compelled to take on $30,000 to $100,000 of non-dischargeable debt for jobs that once required only a high school diploma, or for degrees in fields with no measurable wage premium. The bubble is defined by two key distortions: the sticker price mirage. Universities inflate the sticker price to astronomical levels, e.g. $70,000 per year, then offer selective merit-based aid to high-achieving affluent students they want to recruit, effectively purchasing their enrollment. Low and middle-income students, however, receive need-based aid that still falls short, forcing them to take on massive loans to cover the artificially inflated gap. The sticker price exists to justify maximum debt extraction. The enrollment arms race administrative bloat requires perpetual enrollment growth. This has triggered a systemic lowering of admission standards across thousands of institutions. Universities knowingly admit underprepared students, low GPAs, weak test scores, poor academic readiness, because federal loan dollars arrive regardless of student success. This increases the supply of debt-ridden, academically vulnerable students who are statistically most likely to drop out. 2. The dropped-out debt bomb. The most destabilizing component of this bubble is the debt held by students who never graduate. Estimates show that nearly 30% of all student loan defaulters are dropouts. These individuals incur all of the debt and none of the wage premium. They are left with non-dischargeable debt, no degree, no earnings, boost damaged credit. This combination cripples their ability to enter the housing market, start businesses, or achieve financial stability. It is the financial equivalent of a nuclear reactor producing massive amounts of waste, debt, while failing to generate any usable energy, a degree, or wage premium. 3. The systemic contagion risk, the housing crisis parallel. Defenders of the current system claim that student debt is not a systemic risk like the 2008 mortgage crisis because the debt is held primarily by the federal government rather than private banks. This is a deliberate and dangerous misdirection. While a banking sector collapse from student loan defaults is unlikely, the economic contagion is far more pervasive. Delayed homeownership and family formation. Young adults burdened with debt postpone or abandon major life milestones. Student debt is now a leading factor delaying first-time home purchases. This ripple effect harms construction, finance, real estate, and local economies. They become 30-year economic detainees. Erosion of the tax base. Debt-crippled graduates cannot climb the income ladder at a pace that transforms them into strong taxpayers. Instead of becoming net contributors, they remain trapped in cycles of underemployment and repayment, reducing tax revenue while increasing demand for social services. The federal backstop illusion. Although the bulk of the debt sits on the federal balance sheet, the $1.75 trillion liability represents an immense future taxpayer burden. When mass forgiveness or income-driven repayment defaults occur, the loss is socialized directly to the public. The government guarantees the debt. The taxpayer guarantees the government. The question is not if this bubble bursts, But when the illusion of value collapses, the entire system rests on the premise that a degree S financial reward will always exceed its cost. When enough young adults realize they are earning a median salary while carrying debt loads suited for medical doctors, demand for the product collapses. The primary force sustaining this illusion is the credentialing cartel, the corporate and HR ecosystems that still require a bachelor ess degree as a baseline for middle-class employment, regardless of its relevance. The degree has become a $100,000 entry ticket to a lottery with worsening odds. Structural fragility has created conditions for a critical failure event. A system this unstable, with massive non-performing liabilities held by its youngest citizens and a bloated, self-inflating cost structure, does not gently deflate. It is destined to be struck by a force majeure, an external shock that exposes the rot and triggers the irreversible collapse of the traditional university model. A structurally compromised system, whether a financial market or a physical bridge, does not need a crisis proportional to its total size to collapse. It only needs a tipping point, a single, sharp shock that destroys the illusion of stability and triggers an irreversible loss of confidence. For the American university model, this event will be the mass student debt write-down. This is not a political prediction. It is a mathematical inevitability driven by the grotesque failure of the income-driven repayment IDR plans, which are already creating a MathBEF $500 to $1 billion debt bomb on the federal balance sheet. The IDR time bomb in response to the crushing debt burden, the government introduced various income-driven repayment plans, e.g. Pay, IBR, and most recently, Save. These plans cap a borrower's monthly payment as a percentage of their discretionary income, often at $10% or less. The core fatal flaw of these programs is the loan forgiveness component. After $MathBF $20 or Kanyas MathBF 25 years of payments, any remaining balance on the loan is forgiven. This was meant to be a safety net, but it has become the mechanism of systemic destruction because of the initial tuition bubble, low payments, negative amortization. Due to the high principal and relatively low to stagnant salaries of graduates, the IDR payments often do not even cover the interest, leading to negative amortization. The borrower's principal balance grows every month, often ballooning to 2 or 3 times the original amount by the time forgiveness is scheduled. The MathBEF $20 year bill. The government is not collecting the full debt, but simply accumulating the difference as a massive liability that comes due 20 to 25 years after the loan was issued. The Treasury, in effect, has been issuing a MathBEF 25s, $1 zero coupon bonds of debt forgiveness, and the maturity date is rapidly approaching. The tipping point event is the year when the first major cohorts of IDR borrowers become eligible for forgiveness, and the government is forced to publicly account for the staggering total of the write-down. The zero coupon. Forgiveness. Maturity. Date. The first major wave of IDR and public service loan forgiveness, PSLF. Forgiveness is already underway, but the truly catastrophic event is coming in the mid to late 2030s, when the large cohorts of borrowers who took out massive loans post-Payroll MathBEF 2008 and entered the IDR programs become eligible. The tipping point. The Congressional Budget Office, CBO, is forced to publicly issue a definitive, non-negotiable, multi-$100 billion plus cost estimate for the IDR write-down. The moment this number is official and undeniable, not a projection but a required accounting entry, is the moment of irreversible collapse because it exposes 3 fatal lies. The tuition lie. It proves beyond any doubt that the tuition charged by universities for the preceding 3 decades was fundamentally a fictitious price. The government's accounting of the loss is a formal acknowledgement that the true recoverable market value of the degree was $50 to MathBEFs, $70% less than the price charged. The high tuition was merely a mechanism to transfer money from the Treasury, via the guaranteed loan system, to the university's bloated administration. The debt as asset lie, it formally reclassifies a massive amount of assets on the federal balance sheet into losses. This shatters the illusion that student debt is a functional economic asset, confirming it is a MathBEFs $500 billion plus taxpayer liability, born out of institutional financial malpractice. The degree as investment lie. The public spectacle of a $250 billion government debt write-down to support a generation of financially crippled graduates will be the final, crushing blow to the perception of the degree as a worthwhile investment. It will be the single, most powerful piece of government-issued propaganda, confirming the entire system was a colossal waste of taxpayer and borrower capital. The irreversible consequence, the loss of trust, the CBO. Is write-down will be the signal event that causes market decoherence and triggers the system's irreversible decline, much like the first major institutional failure did in 2008. Once the total mandatory cost of the IDR failure is quantified, Two irreversible shifts occur: student demand collapse, the enrollment cliff, the loss of confidence will be absolute. Future generations, seeing the government forced to write down massive sums of debt for a degree that offered no economic escape, will refuse to pay the sticker price. They will ask, if the government admits this debt is junk, why should I take it on? This will accelerate the enrollment cliff, a demographic and economic phenomenon where institutions are unable to attract enough paying students to cover their fixed, bloated costs. Political backlash and the end of the blank check. The congressional public accounting of the multi-billion-dollar IDR loss will generate an immediate, severe political backlash. Congress will no longer be able to sustain the political fiction of the current student loan system. The blank check that has fueled administrative bloat will be ripped up, forcing a radical restructuring of the federal lending programs and imposing risk sharing on the universities. This financial reckoning, the moment the system must account for the false price of tuition, is the irreversible event. It forces an end to the moral hazard that defined the previous 3 decades, dragging the university into the marketplace of actual economic value, a place its bloated cost structure cannot survive. The mass student debt write-down serves as the detonator, shattering the illusion of stability and forcing the university system into a brutal, overdue market correction. This correction will not be a gentle resizing. It will be a 5 to 10 year period of severe institutional failure, consolidation, and the permanent bifurcation of the higher education landscape. The root problem is the collision of a fixed, high-cost administrative structure with a suddenly elastic and shrinking revenue base. The enrollment cliff meets the bloat floor. For decades, the university ASS financial model was based on the premise of perpetual enrollment growth and the ability to raise tuition by 4 to 6% annually. The tipping point, the write-down event, reverses both. Shrinking demand, future students will refuse to accept the debt burden. Enrollment numbers, particularly at non-elite tuition-dependent schools, will plunge, accelerating the pre-existing demographic enrollment cliff, fewer 18-year-olds, into a catastrophic decline. Price elasticity. For the first time, tuition will become elastic. If a school raises tuition, it will lose enrollment to a cheaper alternative. Instead of raising prices, institutions will be forced to offer massive tuition discounts, deep cuts to the sticker price, to attract a dwindling pool of viable students. The model instantly reverses. Revenue per student drops, while the fixed cost of administrative bloat remains high. The 3 waves of institutional failure. The resulting market correction will unfold in 3 distinct waves, with predictable and devastating consequences for the American higher education map. Wave 1, small, tuition-dependent private colleges, the initial crash. These institutions, typically with enrollments under 3,000, have low brand recognition, minimal endowments, and depend on tuition revenue for 80 to 95% of their operating budgets. They survive by offering massive tuition discounts, often 50 to 60%, to meet enrollment targets. When the tipping point hits, they lose the ability to attract even the discounted student. Outcome: rapid, unceremonious closures or mergers with larger, stronger institutions. This wave has already begun, but the collapse of confidence will accelerate it into a flurry of bankruptcies, leaving local communities stranded and regional debt markets exposed. Wave 2, regional state universities, the political nightmare. These public institutions, the flagship schools of state university systems and their satellites, are the backbone of middle-class education and are burdened by the largest, most entrenched administrative bloat, required to manage state political mandates, Title IX, compliance, and massive athletic departments. They rely on a mix of shrinking state appropriations and high in-state tuition. When enrollment drops and states refuse to increase funding due to national economic contraction and debt crisis, they face insolvency. Outcome: large-scale consolidation enforced by state legislatures. Entire campuses will be designated satellite learning centers. Academic departments will be merged across hundreds of miles. And non-STEM programs, humanities, social sciences, will be systematically eliminated in favor of cheaper, career-focused vocational training. This will be a messy, highly political process, sacrificing academic diversity on the altar of budget solvency. Wave 3, flagship and elite institutions, the retrenchment. The Ivy Leagues, Tier 1 research universities, R1s, and major flagship public universities will not collapse, but they will be fundamentally changed. Their vast endowments and $1 billion plus research grants provide a buffer. However, the loss of confidence in the degree's value will force a brutal retrenchment of the administrative apparatus. Outcome: massive 20 to 40% cuts to non-instructional staff. The luxury arms race will cease. New construction will halt. Administrative bloat will be purged by necessity as endowment returns weaken and political pressure to justify $80,000 tuition becomes unbearable. The focus will revert to the 2 things they can credibly sell: research and credential value. The market correction is a 30-year re-equilibration compressed into a decade. It is the necessary, painful process of bringing the price of the degree back in line with its value, achieved by destroying the administrative cost floor that the student loan system created. For the American economy, this is a financial cleansing. For the American university, it is the death of the 20th century model and the terrifying birth of a new, leaner, and more politically controlled institution. The new educational bifurcation. The structural collapse of the traditional university system will not mean the end of higher education. It means the end of the debt-financed, amenity-driven, administratively bloated 4-year BA factory. The post-collapse landscape will be defined by an immediate, permanent bifurcation of the educational market, driven by two new, non-negotiable economic realities: risk-sharing and demonstrable ROI. The political and regulatory iron fist. The final phase of the collapse will be a political response driven by the shock of the IDR write-down, forcing the government to fundamentally restructure federal lending. The most critical change will be the implementation of institutional risk-sharing. The 10% rule. Congress will mandate that any institution receiving federal student aid must absorb a percentage of the loan loss, e.g., 10-20%, when a former student defaults or receives mass IDR forgiveness. Irreversible change. This immediately destroys the university's 30-year moral hazard. The institution becomes financially exposed to the student's success. As a result, underprepared students will no longer be admitted. Low ROI programs, degrees with no measurable wage premium, will be cut. Institutions will invest aggressively in career placement and tutoring to ensure student success and loan repayment. Administrative bloat becomes a liability. Paying a dean of student engagement $200,000 becomes a direct threat to the balance sheet. This shift, the imposition of risk, is the final irreversible nail in the coffin of the old model. The new educational bifurcation. The market will split into two distinct high-value models with nothing surviving in between. Model A, the hyper-elite. Credentialing cartel, the citadel of research. Who? The top 50 research universities, R1s, and the Ivy Plus schools. Price will remain astronomically high, potentially 100,000 plotters per year. Value proposition. They sell scarcity and network. The degree is a guaranteed ticket into the top 5% of global finance, technology, and policy jobs. Focus. Cutting-edge research, PhD production, and the maintenance of a globally exclusive brand. Undergraduate classes will shrink as selectivity increases, making access limited to the ultra-wealthy and the hyper-gifted. Model B, the hyper-efficient vocational engine, the ROI factory. Who? Community colleges, state university satellites, specialized polytechnics, and new private credentialing-focused tech academies. Price? Driven down dramatically by competition, likely returning to 1990s inflation-adjusted levels or lower. Value proposition. Demonstrable ROI. Education becomes a 12-18-month vocational sprint to a high-demand, high-wage job. Focus. Competency-based education, 100% adjunct faculty, maximum use of online tools, and zero amenity campuses. Curricula will be dictated entirely by labor market demand. The large, general-purpose, non-elite, tuition-dependent private university becomes an extinct species, lacking both the elite brand, Model A, and the cost efficiency, Model B. These institutions will be trapped. The final reckoning. The 30-year experiment in debt-fueled educational expansion ends with a generation of graduates paying the final bill. The collapse of the university system is not a tragic accident. It is a necessary economic purification. The system simply reached the point where the cost of maintaining its financial fiction exceeded the cost of its destruction. The mass IDR write-down is the final proof. The degree became a $100,000 loan to a bureaucratic class that never earned the money, paid for by a generation that can never repay the debt. The system is structurally irreversible. Only the timeline remains.